So, mid-year review, talking about the second half of 2025. And my gosh, first of all, it's crazy to think that we're already halfway through 2025. I don't know about you guys, but time seems to be going faster than ever right now, and it's kind of scary. And I don't even have kids yet, so it's a crazy concept to think about how fast this year has gone. But let's just talk about like so far this year. What have we seen? Well, we saw a change in the leadership in the United States. Of course, the Trump administration taking over in January, and we've seen markets do some crazy things since then. We've seen oil prices come down a lot. They've been recently jumping back on some geopolitical stuff happening in the Middle East. We've seen the stock market drop significantly and then bounce all the way back. We've seen Bitcoin hitting a fresh all-time high, hitting 112, I think, recently. You've had gold prices hitting fresh all-time highs again and again. Gold has had a remarkable 2025. And you know what? 2024 was also remarkable for gold. So we're going to dive into that. We're going to talk about the kind of landscape that we're working with, but we can't look for the rest of the year until we understand where we're coming from. Right. So when we talk about, the 2024 overview, or I'm sorry, the first half of 2025 overview, how have things been going in the economy? How have things been looking for the Federal Reserve? What about the state of businesses? Are they performing well? So what we're going to do here for evaluating that circumstance and looking at how that might project into the rest of this year, we're going to be taking a high-level look at the macroeconomic trends and global policy shifts, right? So we'll talk a little bit about that in this session. Additionally, we'll also be looking at the positioning of institutional traders versus retail traders or investors. You know, what is actually kind of crazy, just as a side note, in all of this craziness in the stock market that we've seen in 2025, the retail trader actually did quite well in buying the dip in the stock market. A lot of institutions actually de-risked in the big tariff uncertainty, sold a lot of shares and really got very, very negative on the market. So did a lot of retail traders too. A lot of retail traders were on the wrong side of that, but there was a lot of buying the dip that went on actually in the retail crowd, maybe because it seemed so silly to do so, but it makes you wonder, are retail traders really that bad in terms of general direction? They might be terrible on their timing, but their direction was pretty correct, at least in the indices level. We'll talk about all sorts of different indices, or I'm sorry, markets here in this though. So stay tuned on that. Evaluating current price momentum. This is another thing I want to look at. What's working well in 2025? There's this interesting thing that happens in a calendar year, where what I mean by that is that if gold is doing really well in the first half, does it have some implications about how it might perform in the second half? Well, I can tell you that's a very strong study in indices. If you get a first half start that is really strong or really weak, it can oftentimes tell you about how the remainder of that year is likely to look. Now, why would that be? Well, a big force in that is tax implications. For example, let's say like 2024 is a really easy example of this. If you bought the indices or you bought stocks in 2024, and you had significant gains throughout the year, you're way less likely. In America, right, we pay taxes on any short-term capital gains, and a lot of times what investors, hedge funds, anybody who's sitting on a large gain, which many investors did really well in 2023 and 2024. Those who bought the dip in 2022 were sitting on massive gains in 2024. And so a lot of people, tax strategy plays into a calendar year big time. So a lot of people held through that 2024 period. And, I got to give credit to Chris Pulver, who's going to be on next. He actually called this early in 2024, like mid 2024. Chris Pulver made the statement that, hey, a lot of investors, a lot of hedge funds are sitting on major gains for 2024, and they're likely to hold on to those gains until they can push back those taxes and sell things in 2025. What happened in 2025? Well, you had a big sell-off in the stock market as people de-risked under the tariff uncertainty that came out. Now, of course, the markets have bounced back aggressively since, but we're setting up our picture for how the remainder of 2025 is likely to look. How's the economy? We'll look at some stats on that. How are institutions versus retail positioned? We'll talk about that as well. We're also going to talk about a list of things here in this session. We've got some time here to go through everything. So we're going to be taking a look at gold. We'll look at indices. We'll look at stocks, sector rotation. How have earnings been doing? Currencies. We'll talk about which currencies look strong versus weak for the rest of this year. Commodities, energy, metals, uh, and of course the supply shock dynamics that could be around the corner with all this stuff happening in the Middle East. So we'll like I said, we've got a lot to cover here, and we're going to keep kind of going through all this stuff. But first of all, let's talk about our theme and or bias, right? Look at that. We got the stream here is so quality with James's setup. Thanks for setting all this up, James. Stream looks great. So trade war fears seem mostly behind us. Now, it's amazing how this works in markets, right? People, when it comes to the theme, just like we as humans, we do this, right? Right now, there's always something that is, really, really high, impact news that everyone's focused on. And then what happens? 2 weeks later, we're on to something different. And I'm not saying that those, serious things that are happening in the world right now are not serious. They are total. I'm not taking away from anything of that nature. It's just we live in this 24-hour news cycle. And by the time you get kind of all riled up about something that's happening here, something happens over here that takes everybody's focus to that. So it's a crazy world that we live in right now. There's all sorts of, geopolitical tensions, but maybe the most obvious one to markets is the difficult situation that's happening in the Middle East between Iran and Israel, right? So that's a big question mark, but it's taken away the focus from all of this obsession that the markets have had in terms of coverage, in terms of headline news, in terms of everyone talking about, like, the word tariff in the first half of this year has been aggressively used over and over and over. And my personal theme or bias for the second half of the year is I think that that is mostly behind us. I think the news cycle is going to move past it. I think the markets are not going to make 3% plus moves in a day every day for a while like they did in April, right? I think that that is most likely not going to be the theme, or at least the reason, the catalyst for markets to move higher or lower as much as it was in the first half in the second half of this year. So if you're somebody who, and this is just, again, this is my opinion, I could be wrong about this, something could change, but right now, I think the path of least resistance, when we talk about the whole dynamic here, is that the tariff stuff, trade war fears, seem mostly behind us. Now, why? Well, let's think about it. A couple weeks ago, or I guess a month or so, 2 months ago, Trump was kind of proclaiming that we were going to do 145% tariffs on Chinese goods. That's scary, right? That completely shocks our system. Supply shocks, if you know much about fundamental analysis, are really scary to markets, just like COVID was, right? Or the Middle East conflict, like supply shocks to oil, supply shocks to goods and services. Supply shocks to iPhones, right? Whatever it is, markets freak out about that. Well, now when I say that this is still a potential force to watch for in markets, what I mean by that is, yes, tariffs now being kind of set at 55% are still a big change to the way our supply chain stuff works, right? Imported goods being taxed at a higher rate. But the market is less freaked out, less concerned because we were told 145%. It's kind of like if your parents said you need to do 3 hours of homework when you get home and you just pitched a fit and you're like, no way, that's way too much. I'm not doing 3 hours. That's ridiculous. And they said, okay, fine. Well, let's do 1 hour and then you can play your game, right? That's very like, then you're suddenly like, okay, well, I still got to do an hour of homework, but at least it's not 3 hours. It feels a lot better. And I think that that's psychologically a real thing for markets at this time. So right now, I think that you had this whole fear around, oh my gosh, we're going to get 145% tariffs and inflation's going to go skyrocketing. And now the market's like, okay, we get 55% tariffs. Is it great? Maybe not, but it certainly is not 145%. So the market rallied back, right? The market sold off on this expectation. And then we actually got this. It's kind of like if you were expecting a horrible jobs report number and then we got a so-so jobs number. The market would like that, right? So that's happening with the tariff stuff. So I think that the path of least resistance for the trade war stuff is that it is mostly behind us at this time. unless something dramatic changes. Now, when I say these themes and biases that I have, I've learned over the years of doing this that having, too strong of an opinion is a recipe for disaster. Now, what I mean by that is that I could be wrong about this. Something could flare up in the trade war that changes things and dramatically worsens. And if that happens, I'm not so arrogant that I can't say, hey, you know what? I was wrong about that and that could change. But right now, my baseline is I think most likely we're moving past the trade war stuff and we're going to start moving on to some of the better stuff that the market is excited about the Trump administration. Tariffs were not very popular, but the Trump administration also has the concept of, their tax cuts for businesses, which could make them more profitable, and things like that the market likes more, right? So the market likes less taxes for businesses because it means, they're going to be more profitable, stocks can go up, etc. They don't like so much the tariff stuff, which can cut big into profit margins for lots of businesses. So there's some good, there's some bad here. And the market, again, like I said, is mostly, I think, digested the trade war scary stuff. So that's a positive for risk assets that I want to kind of just reiterate there. The next one that is also a positive, and another reason that I remain pretty bullish for the second half of the year, is that rate cuts are still seemingly likely in the second half of 2025. I think that there is likely to be 2 to maybe even 3 rate cuts in the second half of 2025. I could be wrong about that, but the direction of rates does not seem to be moving higher, and it does not seem that we're only going to get 1 cut. It seems the market right now is forecasting for 2 rate cuts. I think 2 or even 3 is possible depending on how the data falls in the coming months. So this is obviously very stimulative. Also, it's not particularly bullish for the dollar. So how do rate cuts impact this story? Well, rate cuts are stimulative to the US dollar. I'm sorry, to the US stock market, and they also are a negative catalyst for the dollar. So with that said, let's move on to our next theme or bias. The economy seems to be holding up decently well. And we'll take a look at some stats here in just a second. But I would say that the economy, with cooling inflation data, which has been helpful to the whole story, I think we're going to ride the soft landing story still, right? So we're not seeing a crash in any economic data, at least at the high levels, that I think is worth panicking about, right? Jobs data has been coming in okay. Yes, it's slowing, but so is inflation. So we're likely to get rate cuts, which could save the day on that story, right? So to me, it's like you're not seeing the jobs market crash. You're seeing inflation coming down. Economy seems to be holding up well. Isn't it an amazing economy? Is it like the greatest of all time? No, but it's certainly not crashing either. So I think that that's sort of a spot where I'm like, okay, if the economy's holding up well, despite all the tariff fears, and we have rate cuts around the corner, we paint a picture where it's like, okay, this is not so terrifying. Company earnings were also a strong indicator in the first half of this year. Microsoft, Google, Amazon, Nvidia, these companies showed up, and they showed up big despite the fears that people had due to this stuff, right? So everybody thought, many Wall Street analysts, when it comes to stock performances and company earnings calls, many people expected that this was going to negatively impact significantly the earnings projections, which are important, right? The forward projections from companies about their own earnings, and CEO confidence. They were expecting the trade war stuff to collapse everything going on in corporate America. And to the contrary, we actually had really strong earnings across most of our major companies in the United States. It was a really impressive turnout for the first half of the year. And it was it, as strong as it has been in the past? No, I still think that the tariff stuff is a real concern for investors, or I'm sorry, for CEOs and people of that nature. But we didn't see the fallout that people were afraid of, and so the market is rallying back on that stance. Economies, or at the end of the day, the stock market is a market of stocks, and when we look at the indices at the highest level, the confidence that still seems there based on company projections, earnings that were delivered, They look relatively strong compared to forecasts, which is all that matters when it comes to this stuff. We always want to be looking at what is the expectation versus what shows up. And company earnings as a collective were pretty strong. So this is the final one that I want to get into, which is tax cuts and deregulation. Now, with every administration, doesn't matter what your political background or view is, just leave that to the side for a second. With any, president in the White House, political regime, whatever, there are usually things that a market likes, and there are usually things that a market may dislike, right? So the tariff uncertainty, as I mentioned, was not something that the market liked. People said, no, that's a tax to the consumer. It can really crush things. And to the market's liking, Trump seemed to really have backed down from the really strong stance that he took on that April 2nd. When he was holding up the billboard like this, right? When he was doing all this, the market, myself included, was like, holy, we're really doing this thing. And, maybe that's part of his negotiation tactic. I don't know. We're not here to get into all that. But the point is, right? He really spooked the market. The market absolutely hated that. They're like, no, that is going to absolutely derail the state of the economy, this, that, and the other. And so everybody panicked, right? And so we saw a panic sell off in stocks and indices and risk assets in general. But then we saw the walk back. Like I said, we saw, many analysts, participants thinking that Trump kind of always tends to back down on these things, right? He says a big thing, he's a big bark, and then there's not actually the same bite to match it. And the market likes seeing that. The market's like, okay, yeah, so we're not actually doing those crazy tariffs. Okay, cool. Let's move on. And they bought the dip, right? That's what kind of happened. So then we get into the stuff that the market does like about the Trump administration. And the reason that prior to Trump winning the election, the market rallied on this concept of less taxes and deregulation for businesses, and potentially stirring up and stimulating the mergers and acquisitions part of this economy, right? Companies buying each other, companies coming public, and less less restriction on companies from buying each other can make them more competitive. If you have company A and company B, and company A wants to buy company B, but the government says, no, you can't do that, right? That prohibits company A from getting as strong. But if the government says, hey, go for it, get stronger, get bigger, and it encourages that competitive nature, company A takes company B in, and now it's a bigger and stronger company, right? So I know that was a super overly simplified version of that, but this is the concept of mergers and acquisitions. This is perceived as a very positive thing in markets. In fact, I saw something interesting, and I don't have it in front of me, but I saw something really interesting where a lot of CEOs actually cared more about the deregulation stuff and the ability to accumulate more assets under one company than they even did about the tax cuts, right? So in this case, these are the things that the market likes about the Trump administration. These are the things that the market does not so much like about the Trump administration. And so when we take a look at the holistic view, when I said this is mostly behind us and this is mostly in front of us, you can see why I'm still painting that very bullish kind of perspective on markets, and why I do think in the second half of the year, risk assets will do well. And so that is kind of the summary, the theme and bias component of this presentation on each of these stuff. So let's take a look now at the macro. Also, if you're enjoying this so far, if you're watching this on your YouTube channel or YouTube platform, make sure to hit the thumbs up button. And just as a reminder, we will be sending the recording of this presentation to viewers at the end of this. So if you have to step out or you miss something, don't worry. If you're taking notes, you'll be able to go back and rewatch these components. With that said, let's now turn to our next segment, taking a look at the macro. So we're going to take a look at jobs data. We'll look, which of course, we'll keep this, relatively beginner friendly. Jobs data tracks employment strength and wage growth, which is key for forecasting consumer demand and central bank moves, right? So we want to see the state at the end of the day, right? The consumer is the economy. The state of the consumer in the United States and in most places dictates the strength of the economy or the weakness of it. If everybody's employed and doing well and productive and efficient, that is typically a good thing for the underlying economy. Inflation data is also sort of this really important component to the picture as well. So when we talk about inflation data, we talk about measuring cost pressures across the economy. Now, high inflation keeps policies tight at the central bank level, meaning they need to keep interest rates high so that they can get inflation to go down. And when inflation cools off, the central bank can relax a little bit and allow borrowing costs to go down. Now, I don't know about you guys, and this is probably relevant in many countries that have higher interest rates, not just to the US, but high inflation has been, for the last few years, a frustrating pressure to deal with, because if you've been wanting to put a down payment and make a mortgage or get a mortgage on a home, or you'd like to buy a new car, or you want to finance anything, you want to start a business, you want to, take school loans, whatever you want to do, right? Borrowing costs, right? Borrowing has been expensive, right? So borrowing costs have been expensive. So if you're somebody who wants to borrow money, inflation data is very important to you. Now, inflation is actually like super important to everyone, right? Inflation is really, really important because it impacts all of our lives. You go to the store and prices are racing faster, higher every week. It doesn't feel good. It hurts, right? Financially, that is not a fun experience. But high inflation is also painful because it makes borrowing costs higher for consumers who want to go get a car loan or buy a house, right? So I know so many people. I'm, in my late 20s. I bought a home in 2024, but I know, and we were, we waited for multiple years to find the right option and all that. But I know many people who are my age who are like, we really want to buy a home, but rates are just kind of that factor that make things really expensive. So many people, I mean, everyone in a perfect scenario wants the borrowing costs, right, to go down, because this relieves that pressure of I can borrow money at a cheaper rate and my payments are not going to kill me, right? So everybody wants borrowing costs to go down. Now, remember in the previous slide, I talked about how I think that likely the Fed is going to cut interest rates in the second half of the year. And no, it's not because Trump is pounding his fist and kicking and screaming for rates to come down. It's because the economy seems to be starting to cool off, and inflation has made substantial progress in recent years. So when we look at that, right? Now, again, I'm not saying for or against, whether or not the Trump administration has contributed to that story. I think in some ways they have. Oil prices are lower. We'll see if that can stay the case. But that helps the inflation story. Lower oil prices help to reduce pricing from going up so fast. And as oil, of course, is a big input to the rest of the economy. So we'll keep an eye on oil prices. It's really critical to the second half of this year, which we'll talk about in a second. So we want borrowing costs to be lower. We want borrowing costs to come down. We want these things to continue to happen. How can they be lowered? Well, inflation data is key. If inflation data comes down, they can lower the borrowing cost or the interest rate at the central bank level. Now, the reason that this is so critical is because lower borrowing costs are like juking the economy with stimulus, right? Because if everybody can go out and now borrow money and spend money on homes and cars and borrow to make a business happen, all these things, right? Personal loans, all that stuff. If that is more accessible, then spending goes crazy in the economy, and it can be very good for the stock market and for the underlying economy. We just don't want to do all that spending. Why would we not just cut interest rates dramatically all the time then, if that's going to be so good for the economy? Well, it's because of inflation data. When you cut the borrowing rates, everybody's thinking the same thing. I'm going to go buy a house. I'm going to go do this. I'm going to go do that. I'm going to travel. I'm going to, I'm going to take a credit card loan. All of these things happen at once, and it can cause prices to do what? Prices can go right back up really quick. So the timing of this is tricky, right? The Fed wants to say, hey, we want to cut interest rates. Everybody, including the Fed, wants to cut interest rates. But doing it at the right time is the challenging component. You cut it too soon, you cause bigger problems down the road. You cut it too late, you cause bigger problems down the road. Because if you don't cut interest rates and we enter into a big recession, that's the other side, right? So that's the drama. That's the drama behind Trump and Powell right now. Is he too late? Is he doing the right thing? Well, let's take a look at that. We can also talk about trade dynamics, which of course we discussed a little bit already. But let's now pivot here and take a look at some of the economic data ourselves based on the Edgefinder's kind of top setups. I'm sorry, the Edgefinder's economic report. So I mentioned we need to take a look at some jobs data, and then we need to take a look at some inflation data. And again, remember our theory here is we're going to be taking a look at the second half of this year. So if we're taking a look at first the labor statistics that we want to account for, let's navigate over to some of our key economic metrics. First of all, unemployment rate. So for everybody watching, think about this for yourself. Do you think a 4.2% unemployment rate in the United States is a good statistic, a bad statistic, or a so-so statistic? Well, you may be surprised when you realize that actually, on a longer term historical basis, unemployment rate is actually at a very good level. The unemployment rate in the United States is around in the low 4%, where the average over the long term, as I've said many times on my YouTube channel, hovers around 5.7%. So we are below long-term averages in unemployment rate here in the United States. So unemployment rate is not at a disastrous spot. We've come down since the pandemic. Things have really progressed well, and unemployment rate has relatively stayed in there. It's held together pretty well. So this would be a check mark for the labor data because, again, yes, it has risen from its previous lows around the 3.4% a couple of years ago. It's risen to 4.2, but I would not call this by any means a disaster in terms of where we are with unemployment rate. We're sitting at 4.2%. We've stayed pretty much flat there for a year. This is not bad, right? Unemployment rate has remained in check for the most part. Now, we can continue. We could take a look at the monthly jobs payroll and talk about, how many jobs have been added to the economy recently. What we can also do is we can scroll down. I've got a cool chart down here that I wanted to show you guys. This is, of course, the NFP beat or miss indicator. And so what this shows you here is certain months, right? This is June's report, May's report. Now, remember, they're reporting for the previous month. What we've seen here recently is we had a big beat in the April reported numbers for the month of March. And then we had a beat for the reported numbers for April on that first Friday in May. And then, of course, we had this recent one that we saw where jobs numbers came in pretty much in line with expectations, didn't really beat by much here recently. So when I show you this, what are we seeing in terms of the NFP report? At first glance, you'd say, well, we've been beating expectations, which is true, but we've also in the yellow. This is important that you have the right tools to look at this because it will reveal something interesting. The yellow line is revisions, right? So when we look at revisions, what we can see here is that we've actually been revising each monthly report down recently. Now we've had some revisions higher, we've had some revisions, lower, but in the last couple, it is worth mentioning that the red dot is our forecasted number and the blue bar, everyone, is the one that we actually got. But then what's important to add into that story is the yellow line shows us what previous revisions were doing. So we've been revising the previous numbers down for the last few months. Now, some people will get all sort of tinfoil hat about this and they'll say, they're cooking the jobs numbers. And but you do have to recognize that, they also do revise numbers higher at times. They revise numbers lower. And regardless, it gives us a general blueprint of how the data is falling. So as we take a look at this and we say, okay, is NFP good or bad? I would say mostly it's held up better than people thought it would, right? We've had some pretty good jobs prints, regardless of all of the fears about hiring freezing due to tariffs and all this. We haven't really seen it materialize. So you have to recognize that, okay, we're not seeing dramatic layoffs. We're not seeing huge, payroll cuts. Could that be coming around the corner? Maybe. But you'd be braver than I if you want to try and tell me when the market is going to see those jobs data points start to really materially weaken. People have been doing this as long as I've been in markets, where they make these big, scary forecasts or these big predictions about what the market's going to do. And what I've found is the much easier path is just to look at what the market's doing, right? Rather than trying to predict, oh, jobs data is going to fall off a cliff and it's going to get really bad out there. Let's just look at how the market actually is holding up. So again, unemployment rate is at a pretty steady level, around 4.2%. That's not, now you want to watch these things. This is why we're doing these things, right? We want to keep an eye on this stuff if it changes. But right now, 4.2% unemployment rate, NFP, take a look at this. You've had some jobs prints that have been, relatively stable compared to what people were thinking. Job openings in the United States have been declining, but let's put some context in this, as I've done many times in my videos, which is when we look at the JOLTS job openings numbers, we are now kind of normalizing back to pre-pandemic levels. And so is this crashing? Well, it is certainly trending lower. And this is where, again, I do think that the Fed is probably likely to start cutting interest rates at some point here. This is starting to, or trending down. We do eventually want to see that trend slow, but we're still kind of at pre-pandemic levels, give or take. So to me, this is not a nightmarish story either. JOLTS job openings have been trending down, and actually in the recent reported one, we actually got a better than expected number. So again, when we're looking at the JOLTS job openings, yes, it's cooling, but it's not crashing. And that's the difference that I want to show you guys. The other thing is we can see the demand for labor in the form of our wage growth statistics. How are these looking at? Well, they're holding up pretty well. We have not seen a big drop off in average hourly earnings growth, right? So the growth, the average or hourly earnings growth in America, for the most part, has remained pretty strong. The demand for labor is still there. We're not seeing a dramatic drop off in this chart, and that is important for us to register. So again, if you want to call for big doomsday recession, I would just suggest that, okay, be attentive to the data. Don't just assume it's going to crash out. Look at what it's showing you day to day, week to week, month to month, and you'll be way better off, right? That's the important thing that we want to keep an eye on when it comes to this stuff. So for the labor market component of this, I would say things are holding up decently well. Is it immaculate? No. Is it terrible? No. It's kind of just holding in there decently well. And I think that that is where we could see the soft landing scenario continue to stabilize over time. Now, again, if we take a look at inflation data, and this is the other half, the CPI report has been consistently lower than expectations. Now, I wouldn't have given you this expectation, right? But this is why I think predictions you have to be careful with them. I would not have said to you that, okay, markets are going to see tariffs down the line and they're going to freak out. And I would imagine inflation is going to start to tick up. Well, in actual terms, again, we're data focused here. The red line is expectations. The blue bar is what actually showed up. We've had 4 reports in a row of inflation coming down or coming in less than what the analyst community was calling for. So the smart guys out there have been incorrectly assuming inflation was going to go up more than it did. And it just has not really materialized. Now, again, this is why we encourage, when we're talking about this data, to keep an eye on this. This is why we look at it every day, because this could start to change. We could get inflation starting to spike up. But again, the way that I do my stuff here is I'm reactive. I'm not predictive, because I can't predict with certainty what the inflation targets are going to be, but the market seems to think it can, and I can kind of play the other side to that. It's similar to, and you guys will hear from Chris Pulver in a little bit, it's kind of like implied volatility typically expects more volatility than actually appears in markets, hence why there's a slight edge in kind of being an option seller. The market, historically, the people tend to expect bigger moves than actually occur. Well, same thing in the tariff stuff. I think people overhyped or over feared, I suppose, what could happen. Now, again, something could change, something could collapse. I'm not saying that those things are completely invalid, but the market has a tendency here to overreact and freak out. And so I think that right now things are relatively intact. We have the producer price index. We've had some cooling inflation on this side of things as well. Core CPI month over month, we've had several lower than expected readings here. PCE, this is another preferred measurement of the Fed, you can see has been trending down. This is a tailwind for markets. Having cooler inflation stories is a tailwind for markets. And so let me just jump back to my presentation here, make sure I'm staying on track. Where's my, here it is. So if I pull this back up here for a second and just hit present, let me make sure I'm on track here. Our next section is, whether or not, as we just got done discussing some of the data, right? How does all that look? The next question is, ultimately, what is the Fed going to do with this? What are the probabilities that we're going to cut interest rates this year? Is the Fed's policy currently restrictive? Why does the Fed not cut interest rates right now? Well, we discussed preemptive cutting could be problematic, right? If you cut interest rates too soon, that can be a problem. If you cut interest rates too late, that also can be a problem. And so, of course, the political regime, the Trump administration is pounding the table. You're going to be too late. You're going to be too late. But whether you're Republican or Democrat, that doesn't usually change. Policymakers or politicians always want the Federal Reserve to cut interest rates because it always makes them look better when people can go borrow at lower costs. Now, God forbid, you do that and it causes the national debt to skyrocket because, inflation gets out of control. And then we've got this whole nother round. That's where, the Fed is trying to navigate the ship through murky waters, stormy waters, right? You have, on one hand, if you cut interest rates too soon, inflation could come roaring back. And if you cut interest rates too late, you could send us into a recession and be behind the curve, is what they call that. So when we talk about the Fed rate cut probabilities, I do think that this year you're likely to get a couple rate cuts. I think that's the consensus on Wall Street is you're going to get two. I think we could get 2 or even 3 cuts. I'm kind of like 2.5 rate cuts this year. That's my baseline because I see economic data cooling. We see PMIs. We didn't get into that, but PMIs cooling. So there is some expectation of slowdown in the economy. We also see jobs data starting to, it's cooling. It's not crashing, it's cooling. And at the same time, inflation has really made substantial progress. And that tariff stuff, which is concerning to the Fed as well, has recently, we've seen things improve, right? The worst case scenarios, the 145% Trump tariffs on China, seem to be in the rear view mirror now. And so I look at that and I say, okay, that's not, likely to be the case. And I imagine that the Fed is thinking that way too. They don't necessarily have to love or hate the tariffs, but at least they know they're not going to get the worst case. And so I think that sets us up for a second half where rate cuts are on the table, tax cuts. So again, or tax cuts from the administration, the more positive perceived side of things from the administration, as in retrospect to or in response to the tariff side, right? We talked about the positives versus the negatives and things that we want to look at. I also think it's worth just taking a quick look at some of the current market sentiment tools that we can look at to get an idea of how things are playing out here. So if I go back to the Edge Finder here, and we now navigate just quickly to our overall sentiment indicators, I wanted to show you a couple things that we could look at. So what's market crowd sentiment out there like? Well, despite the bounce back, we do still see a pretty good bit of pessimism out there in this market. And we know an old adage in the market is that the stock market has a tendency to climb the wall of worry in a weird way. When everybody expects the market to go down, the market has this crazy ability to find a way to go up anyways. And when everybody thinks the market's just going to melt up into the sunset and it's going to go to the moon, it has a tendency to find a way to disappoint investors. It's not designed for the masses to make money. That's a weird thing in markets, but it's how it works, right? It's made for the minority of people who are out there on the right side of the market moves to make money, and most people unfortunately are just not on that side very consistently. And so when we take a look at the S&P 500's put to call ratio, this shows us that sentiment is still mostly more negative than it is positive, at least on the put to call ratio. I would say, though, we're still in neutral territory because we haven't crossed the high put demand threshold or the high call demand threshold. We're kind of somewhere in the middle, at least right now. Take a look at the AAII Investor Sentiment Survey, and we can see that sentiment has been improving. The bearish percentage here was super high during all of the craziness. And again, I've been doing this for a long time, and I imagine you're going to hear from Chris something similar. We've been doing this for a while. He's been doing it longer than I have. And when we look at this stuff, when you get everybody panicked, it is amazing. It is absolutely amazing how good the market is at convincing everyone to sell their whole portfolio at the bottom and to go all in at the top. It's a crazy simple concept, but most people mess it up because it actually is hard. When the markets are down and everyone's panicking, it is hard to sell cash secured puts, to buy stocks you like, to have some sort of optimism in a market that is terrified. It's very difficult to do. It's easy to be bullish on markets when they're going straight up. So here's the thing, right? Sentiment is now, I would say, kind of back to neutral. So I want to watch these indicators going into the second half of the year. If you get stuff starting to get frothy, if we see a melt up through those highs, right? If the S&P 500 takes out those previous all-time highs, if we start ripping through on the S&P 500, then yes, I think you want to be careful. I think you want to be, cautious. And this is how I can't tell you what to do. This is not financial advice. As always, I'm just sharing my presentation and thoughts here. As always, I appreciate you being here, but I want you to understand you got to make your own decisions. And we're big believers here at A1 Trading. It's all about sharing insights and education. But at the end of the day, if you're going to make it in trading, it's on you. So here's my thoughts. If we see the S&P 500 melt into the sunset, I am not going to be aggressively chasing that. Even though you've heard me talk on this presentation about how I am bullish on the S&P 500, I am bullish on the indices. I did not get bullish right here. I have been accumulating shares. I've done pretty well in 2025. I've had a good year. But I'm telling you that if we do melt through the highs, I'm going to hold on to stuff that I really like, but I'm going to do what we do regularly on these streams. It's a phrase that Chris and I like a lot. It's the word the words cautiously optimistic, right? So when you get breakouts through the highs, by the time the markets have reached the highs and the masses are flooding back in, that is where I start to just sit back in my chair a little bit. I'm not punching the buy button. I'm not chasing everything. I'm sitting back and I'm saying, okay, most of the time I should have already been in. And if I'm not in, I'm sitting back, right? I'm not going to chase. I'm not going to be silly about it. But I do think that if you get a market melt up through the highs and sentiment starts to flip more extremely euphoric, at that point, what I would do is I'd look to sell covered calls on my own personal stocks that I don't want to hold forever. I would also pause on buying indices aggressively. And maybe if I'm looking at anything, I'd be looking at something else, like maybe gold, right? Gold's back to the all-time highs, but pulling back here. How does gold look for the second half of this year? Well, in some regards, I would say gold has a really positive potential in the second half, because when we take a look at our economic heat map, going back and kind of giving an overview of what we discussed, if we see the data continue to cool off, right? Inflation data continues to cool, and we see, for the US dollar, that is a bearish catalyst. If we get consumer price index, producer price index, if inflation continues to cool, and the economy cools in any way, I think gold could continue to push higher on a weaker US dollar. If we take a look at gold here, we're sitting back at the all-time highs here. And the way I would approach this is I would say, okay, this is not something where I want to chase gold. This is something where I would be interested on bigger pullbacks as a bit of a hedge, especially if you got gold down in the second half and stocks ripping through the highs, then it would be an accumulation phase for me on gold. Meaning longer term, I'd be looking at some buys on gold if we got that sell-off. But I can't justify buying it at the highs unless we have a strong catalyst of dollar economic data coming in really soft and perhaps price action breaking through these previous highs. Maybe there's a trade setup for me on gold in that regard with a tight stop in case I'm wrong. But the story that I like bigger picture for gold would be a retracement buy where, again, the economy, we still see cooling inflation, but maybe the economy sees stock market melt up first. If we get a huge break through the highs and optimism resumes and things are good and we see trade deals and all that stuff, again, I think that we have room for that market to squeeze higher on all that stuff. But then as you get more and more euphoric, that's where I say, okay, this is where we book profits. This is where we kind of covered calls. This is where we just slow on the buying, right? So the timing of buying indices and gold is something that, to me, you don't want to be chasing when everyone else is already doing so. You kind of want to wait for those opportunities. So when it comes to let's go to our top setups page here for a second. And this is going to give me just a general viewpoint of how I'm seeing things in the second half of this year. So I do like oil as a second half of the year hedge. Oil and gold, I think actually have more upside in the second half of this year. Gold, I think, could consolidate. It's not like my top pick by any means, but commodities wise, US oil, I think, is trending higher. I think the economies are holding up in the world better than people thought. And the demand side for oil actually looks strong. So you're getting this big sell off. There's probably, I'm not keeping up with it as we do this presentation, but I imagine this is some sort of geopolitical announcement, some progression. Let's hope for all of our sakes when it comes to what's happening in the Middle East, that we get further peace progression just from a humanitarian standpoint. As always, that's the policy of the channel. We don't want to bet necessarily on or wanting to profit off of something horrible happening in the Middle East, but we do need to think about it from a portfolio perspective. Could I add some oil as a hedge here? I really like the idea of getting long oil. If we get a pullback to like the 61.8% retracement, we've had this big move higher, beautiful push, right? And adding it in as a hedge in my portfolio is not something I'm too worried about. Just to get into stocks for just a second, I'd probably be looking to buy energy stocks if we got a dip in energy stocks. I like the idea of spreading out my portfolio, not just being all Mag 7, right? When I say Mag 7 for the newbies in stock world, talking about Amazon, Apple, Google, Nvidia, things like that. So I want to spread out in the second half. Now, that brings me to another part of the market that I like, which is the Russell. The Russell, is a very much a kind of broad index of small companies in the United States. I'm currently long the Russell, but I also like most of the indices. So when we take a look at the S&P 500, the Nasdaq, I've mentioned that I am bullish on these things, but when I say bullish and I reiterate cautious optimism on these things, I'm not saying I'm buying massive out of the money call options on the SPY. I'm not doing any of that. I'm talking about buying selective companies that I really like, or buying the index on retracements, right? That I think give you a better risk to reward profile. So on this Russell trade, I of course I can pat myself on the back here for a trade that I'm already in, but I caught this thing on a pullback and it went well, and I'm trailing a stop loss and would like to continue to doing that. I'm not long the Nasdaq, so here's an example. If we get the Nasdaq rolling over for a couple days, couple weeks, right? Then we're looking at a story where okay, I could be buying that dip with expectations. I think most likely we see new highs this year. And so that gives me a better risk to reward. But right now we're not, new highs this year is hardly saying anything when you're 1.3% away. If you get 5-6% pullbacks before then your risk to reward profile becomes really good. So the way I'm viewing indices at this time is bullish, but only adding if we get proper pullbacks. I can't justify chasing this thing. I can't justify adding a whole bunch of NAS longs at this moment. I'm long the Russell, so I'm already exposed. I bought a bunch of stocks earlier in this year in the April sell-off. We talked a lot about that on the show, buying a lot of stocks that I'd liked for the long term in that dip, despite the scary headlines. But in terms of where we are now for the second half, I am bullish on the indices, but waiting creatively or patiently for better opportunities to pick them up on the long side if we can get that. Like I said, with gold, I do like the idea of having it in the portfolio alongside oil as a hedge, but would need to see pullbacks and kind of the story to weaken a little bit for gold. That would actually give me a better risk reward profile on buying it personally. So there's something to think about. Let's move on now to currencies. So if we talk about the dollar index, where are we at? Dollar index is continuing to push lower. Now, when we talk about the dollar index, this has been a theme in 2025. You want to talk about one of the cleanest examples of a trend that's occurred in 2025? Look no further than the US dollar. The Trump administration, with their trade, trauma and all the deals and stuff that are supposedly coming in, all this stuff, the market as a whole has pretty much sold America in terms of a lot of assets this year. Now the stock market has come back. But the US dollar has not. We have not seen the return to strength of the US dollar. In fact, we are back down to almost fresh lows for 2025. Do I expect that to occur or to continue in the second half of this year? Well, the answer is most likely, I think that the path of least resistance for the dollar index is to continue to the downside this year. Now, again, I mentioned I expect rate cuts this year. I think rate cuts are likely coming down the pipeline. I also think that there's a little bit of, if I'm another country and all this stuff, I'm probably saying if I'm another country that does trade, I would say we are really exposed to the US and I want to get rid of some US dollar stuff, right? I don't want to be so exposed to one guy in the White House who you may like, who you may dislike, but the next guy might be crazier. You never know in this crazy time that we're living in, right? You might get a more now I don't mean to say as in Trump is just crazy. That's not what I'm saying. What I'm saying is the next president could do policies that more impact a country outside of the United States, right? So you can get these really, really volatile single people that, as another nation, you may not want all that exposure to the one person in the White House. So I think that there might be a continued kind of trend lower, some unfavorable moves for the US dollar. Not only that, but I do think that the US economy, the labor data, all that stuff that we got done discussing is still kind of pointed in the direction of a weaker dollar, at least for now. So I remain mostly bearish on the US dollar. Going into this year, I actually thought that the US dollar would be more neutral or sideways. I've been wrong about that. Dollar has been moving lower because, kind of no one really expected the trade war stuff to go, at least not me and many people that I know and listen to. It was kind of a out of left field how aggressive the tariff side of the Trump administration was. And so the dollar kind of continues to move lower. We're back down to the lows. Momentum seems to be to the downside for now. And we can turn to other currencies that have benefited from this. Who's a big beneficiary? The number 2 spot, the euro. Euro's done really well this year. Now, if we take a look at the European economic heat map too, something to notice here is that the euro, we've had some pretty good stocks impact data here. And I'm actually long the DAX for this reason. I picked up the DAX last week. Pulled back to a level of support. Many of you guys probably know exactly what I'm talking about. I can pull up the DAX. This is kind of a trade based on the economic data out of Europe, right? It's been relatively stronger than what analyst forecasts are. I'm not saying that the European economy is this shining example, but how have things been holding up? Well, the PMIs came in strong. GDP growth beat estimations, right? Employment change been okay. Unemployment rate stayed flat recently. Inflation's been cooling, giving the ECB the chance to cut interest rates. This is part of the reason why the euro is looking a little soft, is because inflation data suggests more rate cuts, but that's positive for stocks. So I like the DAX, right? So for that story there. So the euro itself, though, looks very, very strong in terms of momentum here against the US dollar. The British pound also looks strong. So my theme here is mostly short dollar, long other things. Now, from a long-term perspective, however, do I think the dollar has massive downside to go? The answer would be no. I do think that in the short run, perhaps for the next few months, the dollar index likely still has some negative headwinds. But if you take a long-term chart, you say, do you think the US economy is going to outperform other places? The dollar, the currency, should positively reflect that. So to me, most likely the dollar does continue to push lower, but on a longer term basis, I still think it is likely to stay as the reserve currency. And so on a longer term basis, maybe there's some opportunities to buy the dip on the dollar index. So it depends what your time horizon is. Super long term dollar index, if it really trends lower, I think that the straight up strengths of the two economies side by side, for the long term, I would actually favor the US dollar in most of these currency pairs. But in the short run, the economies other places seem to have a little bit better of a layout for me personally in my own trading approach.
I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.